The information I'm about to share is crucial for any small business owner or investor. So there are really only three markets of significance. Everything else is pretty much an overcomplication or a distraction. Basically, what you have to understand is in America, income and wealth are distributed unevenly. I think everybody knows that. I don't think people realize the degree to which that's true. So for instance, the top 1% has about a third of all wealth. The top 1 to 10%, so like the next 9%, has another third of the wealth. And then the 10 to 50% has another third of wealth. And then basically everyone who is lower than 50% has nothing. And then when you look at income distribution, it follows a similar pattern, right? So the top 20% of income earners represent over 45% of all consumer spending in the entire country. So you have three markets. You have the top 1%, you have the top 1 to 10%, and you have the top 10 to 50%. And so whenever you're trying to do a business, if you're trying to go after customers in the bottom 50%, these people have no income and they have really no wealth. And then then you just have to decide, like, what kind of customer do you want if you're a small business owner, and then flip it onto the investor side of things. You need to understand exactly how that company that you're investing in is basically prioritizing these segments. And the reason why that's so critical as an investor is because if you look at price to earnings ratios, so like how expensive are the earnings that you're buying whenever you buy a stock, the price to earnings ratio has fluctuated over time, but it hasn't fluctuated nearly as much as the increase in earnings. So most of the increase in the stock market is actually because companies are making more money. The question is this, like, who are they getting that money from? Because, in 2005, the top 20% of income earners, they made up less than 15% of consumer spending. But now they make up over 45%. So the companies that have had the biggest increase in earnings probably are mostly targeting people in the top 20% in aggregate. So that's something you need to think about. The wealth distribution in this country, the fact that it's unequal, that has a lot of implications for investing and politics and business operations and all this kind of stuff. However, you have to make a decision. Do you think wealth disparity is going to keep getting bigger? Or do you think that wealth disparity is going to go the opposite direction? I will say this. There are very few examples in history where a population that's already highly educated and already is industrialized, like the United States and a lot of other first world countries, there are very few examples in history where you've actually been able to reverse a increasing wealth disparity. And the reason why is basically because the major mechanisms of doing that is industrialization and education. And so, especially with things like AI and things like that, there's a lot of reasons why somebody would expect for the wealth disparity, the difference between the rich and the poor, to actually get much bigger over time. And that's going to affect where money flows in the economy, right? If the wealth distribution gets too extreme and a ton of wealth gets, basically wealth and income gets, stuck in the top 1%, the top 1% as a group is really the only, group of people that actually saves any of their money. So the velocity of money, the amount of basically times that a dollar circulates person to person, business to business per year is going to drop a ton. And what that really means is that, as wealth and income concentrate towards the top 1%, basically there's going to be less money even available to be captured for everybody else. And so, that is something you got to think about. If you're a small business owner, certainly, it's also something you need to think about as an investor. Because ultimately, if you're investing in companies rather than like debt instruments, ultimately the performance of your investments are going to be highly correlated with the earnings of that company over time. So that's just a framework that you got to keep in mind. It's very important, especially if you're a long-term investor, especially if you're a long-term business owner. If your time horizon is 10 to 20 years or more, you got to think about this stuff, because just think about how much of a difference there was from 2005, when consumer spending, 15% of that was from the top 20%, to now. That's basically 20 years, and it's increased. It's pretty much gone up 3x, right? So that's a huge difference. And depending on how things play out going forward the next 20 years, like, what's that going to mean for your investments? What's that going to mean for the kind of business opportunities that you should pursue? What's that going to mean for your children's, ability to, make something of themselves? What should you prioritize when they are growing up? What colleges, what majors, et cetera, et cetera. Like, these things are all going to be very important, because if you're making the economy increasingly about a smaller group of people, basically in that scenario, what you want is you want to be in that group of people, number one, and you want to have your business services and products targeting that group of people, right? Like, if we get to a point where the top 20% of income earners are making up, let's say, 2/3 or 3/4 of all consumer spending, and pretty much everyone else doesn't really matter. Everyone else is going to be basically stuck where they are. Money is going to be circulating very rapidly there, but there's not going to be enough money going around for anyone to really do anything with it, like, meaningful. Like, they're not going to be able to generate high incomes or high amounts of wealth accumulation, just because while the money is going fast, there's just not enough there. So those are just some thoughts. Anyway, like and subscribe if you like this kind of content. We'll be talking about related topics going forward.